LA real estate values always go up, right? Especially in the past 10 years. Yeah, I've been hearing that one for a long time. So what if I told you that buying a multifamily building in LA in 2026 puts you at or below 2016 prices? We're going to show you a property in LA that sold in 2016 for $3.85 million, and it just closed in January of 2026 at a number that you won't believe. 10 years, negative return in Los Angeles. You heard that 2026 is the new 2016, right? If you own multifamily in LA or you're about to inherit a building or two, don't wait to make a change until after the Olympics leave town. You need to watch this video right now. Let's jump all the way back to 2016. I found the perfect example to prove what's actually happening with multifamily values in LA. I was researching comps for a potential new listing, trying to determine value, when I came across a transaction that made me do a triple take. This property in Los Angeles sold in 2016 for $3.85 million, and it just closed again in January for $3.7 million. 10 years of holding, fixing, and rent increases, and it lost $150,000 in value, and that's before commissions, carrying costs, every dollar invested into that building over the decade. Now I know what some of you are thinking, hey, that's one building, maybe there's something wrong with it, it's one data point, so let me give you another one. It's not tough to find. This one here on Carlton Way in Los Angeles sold in October 2017 for $10.75 million. It's been sitting on the market and it is listed at $8.775 million. That's nearly a $2 million loss, and it's another one with the owner renovating and increasing rents. And the pain isn't limited to a $2 million loss in equity. The county's property tax assessment is based on a value of that building at over $12 million. This means the current owner has lost money and is paying over $50,000 extra in property taxes every year, since the market says that it's worth $8.7 million or less, but the county thinks it's worth over $12 million. Think about that for a second. The government thinks it's worth more than the market does, and the current owner is stuck paying the difference every single year. So look, we've all seen real estate values rocket up in the past decade, especially since COVID. But LA multifamily didn't just get more expensive to own, it fundamentally became less valuable as an investment. So what happened in LA? There's a lot of layers to the answer. Mortgage interest rates. When these buildings were trading at their peak prices, you could finance at 3.5%, maybe 3.6%. Rates got even lower during COVID, but today you're looking at 6% or higher. And sure, rents may have gone up since then. We're going to circle back to that, but costs have gone up right alongside them. Insurance, maintenance, property management, utilities. The net income on a lot of these buildings hasn't nearly moved as much as the gross rents would suggest. The net income has barely budged and the interest rates have nearly doubled. Both push in the same direction for an investor trying to make the numbers work. With more money going to debt service, it's tougher for a property to pencil. They need a lower purchase price to have any shot at positive cash flow. These interest rates are affecting new acquisitions and larger buildings which have adjustable rate financing that could be resetting now. And that's exactly what we're seeing in the sales data. But it doesn't stop there. Rates are just the beginning. Because what makes LA uniquely difficult isn't just interest rates, it's the regulatory environment stacked on top of the interest rates. The eviction moratorium during COVID, LA City Council and LA County Board of Supervisors voted to keep extending it, making it one of the longest moratoria in the nation. And yes, there was rental assistance money, but a lot of those funds never actually made it into the landlord's pockets. You had buildings where tenants weren't paying, the assistance programs weren't delivering the money to who needed it, and you couldn't do anything about either one as a landlord. And that erosion of trust in the asset class didn't just disappear when that moratorium finally lifted. And of course, there's the Rent Stabilization Ordinance for LA City and the Rent Stabilization and Tenant Protection Ordinance for LA County. Now these have been around for a while and cover hundreds of thousands of rentals, but during COVID, landlords also couldn't raise rent at all. Zero. for years. Well, every single other cost went up, insurance, maintenance, property taxes, utilities, all of it climbing. And then the income side of the equation, frozen. That's not a California problem, that's a uniquely LA problem. And speaking of insurance, this one isn't unique to LA, but it's hitting LA multifamily hard. Insurance costs are spiking across the board. Companies are sending up their drones and they're flagging buildings for roofs. They're sending in inspectors to look at electrical panels, and they're canceling policies on buildings that have been insured for decades. So now you've got owners scrambling for coverage, paying significantly more, and in some cases having real trouble finding it at all. That's another line item that's moved substantially in the wrong direction and hitting LA particularly hard. So then the wildfires happened. LA County extended price gouging protections, that's Penal Code 396, and right now, this has been in place for well over a year. Even if a tenant moves out, you can't increase the rent more than 10% for the next renter. So this is anywhere in LA County, whether it's incorporated or not, and not just rent-stabilized buildings. That is the whole county for any rental property. So if a landlord had a low rent before, let's say a tenant paying $800 for a 2-bedroom, if the tenant moves out, landlords right now cannot legally increase it to more than $880 a month. And of course, we have a cooling ordinance in LA County, and LA City is expected to follow. And if a tenant stops paying rent under current rules, they have to be behind several months before a landlord can even start the eviction process. So you get to carry a non-paying tenant, sometimes for a long time, before the law gives you any recourse. Stack all those layers on top of each other: rates, frozen rents, rising costs, insurance chaos, extended eviction timelines, price gouging caps. That's what LA multifamily owners like you are dealing with right now. And if there's anything I missed, just let me know in the comments below. Now, some of you watching this video may have inherited one of these buildings. Maybe it came from a parent, a grandparent, and you've been holding on to it because that's what you were told to do. Don't sell the family real estate. But it could be an anchor to the family legacy. Now, there is actually a silver lining in the stalled property values in LA. If you inherited a building in the last 10 years plus, you potentially could sell and owe little or no income tax. You received a step up in basis when you inherited the property. So basically the value of the building resets to whatever it was worth the day you inherited it. But because values have barely moved, if you were to sell, you're selling close to the inherited value, which means little or no capital gain and little or no income tax on the sale. Of course, I can't give you tax or legal advice. Talk to your CPA, but if you've been holding on to a building partly because you're scared of a big income tax bill, you need to have this conversation. And for those of you thinking about passing one of these buildings down to the next generation, think carefully about what you are actually handing them. Under Prop 19 in the state of California, when you pass, LA County is going to reassess the building. It is not going to stay at the property tax rate that your parents or grandparents paid for it. It resets to the current market value, and that is according to what LA County thinks that value is. Remember the property on Carlton Way? The market said it was worth 8.7 or less, and the county thought it was worth 12. Your heirs could inherit a property tax bill based on a number that's 50% higher or more than what the building would actually sell for. And this may be on a building that's already struggling to cash flow. That is not a gift. That's a thorn in the family's side. And of course, it isn't your fault. It just happens to be because the property is located in LA. Here's the thing. There are options. A 1031 exchange lets you move that equity out of a market that's been working against you into an asset that's in a location that's actually appreciating and where you're appreciated. Something with better cash flow, a more landlord-friendly regulatory environment, so a higher return and fewer headaches for your heirs. You could leave the next generation an appreciating asset in a market that wants investors, instead of a building that's in a market that spent the last decade making it harder to be a landlord. If you're watching this and thinking, I am worried about my portfolio, but I don't know who to trust, we work with residential portfolio owners on strategy, not chasing 1 or 2 transactions, but figuring out what actually makes sense for you and your family in the long term. There's a link in the description below. So here's the thing, if this conversation made you uncomfortable, good. That means that you're taking it seriously for you and your family. So let me leave you with a tough question. A couple years from now, after the Olympics leave town, Honestly, do you think the regulatory environment in LA looks better or worse for landlords? How about 10 years when everyone's saying 2036 is the new 2026? Any better then? If your honest answer to that question is it's worse, then holding isn't a strategy. It's just postponing the decision for you and your heirs while values continue to drop and headaches continue to get worse for landlords. Making a change is hard. A 1031 exchange takes planning. Letting go of a building you've held for 20 years or that you came from your family, that's not easy emotionally or logistically. But every owner I've worked with who made that move, who's repositioned into a market that doesn't fight them every step of the way, they all tell us the same thing. I wish I would have done this sooner. Reach out if you're ready to talk, the link's below. And if you want to keep thinking it over, I understand, no problem. But you need to see this next video right here.